What if I told you that one of the most powerful forces shaping our economy operates largely in the shadows? When you think of influential names in modern finance, you might think of Goldman Sachs, JP Morgan, or Morgan Stanley. But there's another player in the game: private equity. This is a world of investing into assets not available on public markets. This industry has not only reshaped businesses and influenced economies, but also sparked significant controversy for practices that have ripple effects on everyday individuals like us. Private equity firms manage over $4 trillion in assets worldwide, a sum greater than the GDP of Germany. And today, we're diving deep into this financial powerhouse. We'll uncover how private equity's high-stakes game is impacting not just boardrooms, but your life too. Join us as we explore how this industry reached its peak and the headwinds it now faces. Let's rewind back to the origins of private equity, or PE. The narrative begins in the post-World War II era with the emergence of venture capital firms, which primarily focused on funding early-stage startups and burgeoning businesses. However, it was during the 1980s that private equity truly revolutionized the investment landscape and changed how established private companies were managed, sold, and acquired. The rise of PE introduced a new wave of high-stakes, high-reward investment strategies that redefined the rules of the game. Private equity didn't just invest. They bought struggling companies, turned them around, and sold them for staggering profits. Firms like KKR made headlines with massive leveraged buyouts, such as their legendary $25 billion acquisition of RJR Nabisco in 1989. This deal not only shaped the industry, but also inspired a best-selling book and movie. Private equity's golden age was defined by high returns, aggressive deal-making, and market dominance. PE firms expanded rapidly, investing across sectors like tech, healthcare, and consumer goods. Leveraging high amounts of debt became the name of the game during this time. This drove deals such as KKR and TPG's $45 billion acquisition of TXU in 2007, the largest acquisition in private equity history. Easy access to credit played a crucial role in fueling large-scale buyouts. With favorable lending conditions and access to large amounts of capital, PE firms took on more debt to finance acquisitions. This amplified their returns and quickly attracted institutional investors who were lured by the promise of higher yields and diversified portfolios. PE firms were influencing markets globally and reshaping corporate strategies. They implemented aggressive restructuring, cost-cutting measures, and operational overhauls in their acquired companies, driving substantial profitability. Although the heavy reliance on credit also introduced significant risks, easy access to credit played a crucial role in fueling large-scale buyouts, a vulnerability that would become apparent during the 2008 financial crisis. So what happens when a financial strategy that once seemed invincible starts to falter? Once an exclusive investment strategy reserved for the ultra-wealthy, private equity has gone mainstream, leading to fierce competition within the industry. This rapid growth has created a crowded market, with more firms chasing the same assets and businesses. As competition heats up, acquisition prices have skyrocketed, driving up valuations and making it harder to uncover undervalued opportunities. This saturation is putting pressure on returns, as higher entry costs often lead to diminished profits. Ironically, the very popularity that propelled private equity's rise is now making it difficult for the industry to maintain its historic level of performance. This brings us to the next major challenge facing private equity today, and that is that returns aren't always as impressive as they seem. While the industry has a track record of delivering strong long-term returns, it often struggles to consistently outperform the broader market once risk and fees are taken into account. unlike public companies, which are required to disclose detailed financial statements and asset valuations, private equity operates with far less transparency and isn't held to the same rigorous reporting standards. Although private equity firms do provide some reporting, it's often less frequent and less detailed than what's available in public markets. These reports typically rely on estimated valuations and financial metrics that aren't always updated in real time, which can obscure the true performance of investments. This lack of transparency creates uncertainty for investors, making it harder to accurately assess the value of their holdings and gauge the actual returns they're receiving. This lack of transparency doesn't just impact investors, it has real-world consequences that extend far beyond financial statements. While private equity's opaque practices leave investors in the dark about the true value of their investments, they can also mask the impact these firms have on the broader economy and the people who work for the companies they acquire. Behind the scenes, the pursuit of profitability often leads to aggressive cost-cutting measures that can have a profound effect on workers and communities, with labor costs being a primary target. This typically means layoffs, wage cuts, or restructuring roles. While these tactics may boost short-term financial performance for PE firms, they often come at a steep price for workers, resulting in job insecurity, reduced income, and lower morale. On a broader scale, such cuts can ripple through the economy, leading to higher unemployment, reduced consumer spending, and ultimately stifling economic growth while widening income inequality. High-profile cases like Payless ShoeSource, which filed for bankruptcy twice under private equity ownership, showcase the devastating effects on employees and creditors. In 2019, the House Financial Services Committee even held hearings to examine private equity's role in bankruptcies and job losses. Testimonies during these hearings painted a grim picture of the human toll inflicted by private equity's aggressive tactics, with countless stories of layoffs and financial instability following buyouts. Private equity isn't just disrupting the labor market, it is also having profound impacts on housing, affecting homeowners, buyers, and renters in significant ways. In 2021, Blackstone made headlines by purchasing a $6 billion portfolio of rental homes, highlighting private equity's growing influence in the residential real estate market. As PE firms increasingly invest in residential properties, they are acquiring vast numbers of single-family homes, apartment complexes, and even entire neighborhoods to convert into rental properties. This aggressive acquisition strategy has driven up home prices, making it harder for individual buyers to compete and afford homes. It has also led to rising rents, reduced maintenance, and a lack of investment in the communities where these properties are located. Critics argue that private equity's relentless pursuit of profit has transformed housing into a commodity, prioritizing returns over the needs of individuals and families. This focus on maximizing returns has pushed more people into long-term renting, limiting their opportunities to build wealth through home ownership. With institutional investors like Blackstone dominating the market, the traditional pathway to home ownership becomes increasingly inaccessible for many, raising critical concerns about equity, stability, and the future of housing as a fundamental human right. As private equity stands at the end of its peak, the industry is at a crossroads. Once celebrated for its high-stakes deals and soaring returns, private equity now faces intense pressures from a market flooded with competitors and shifting economic conditions. With rising economic volatility, fluctuating interest rates, and mounting public scrutiny over its impact on labor markets and housing affordability, the industry is confronting a pivotal moment. Stricter regulations and demands for greater transparency threaten to reshape the landscape, challenging private equity firms to rethink their strategies and adapt to a new era of accountability and competition. To thrive in this evolving environment, PE must pivot from short-term gains to long-term value creation. Firms will need to navigate complex regulatory landscapes and address both financial and social goals. Investments in emerging sectors like technology and renewable energy, which align with broader economic trends and societal needs, will become crucial. The ability to balance profitability with social responsibility while maintaining investor confidence will determine the future trajectory of private equity in this high-stakes game. Will private equity reclaim its former glory, or will it falter under the weight of its challenges? One thing is certain, the financial world will be watching closely. What are your thoughts on the future of private equity? Share your perspectives in the comment section below. Thanks for watching. Don't forget to like, subscribe, and hit the notification bell for more explorations into the disruptions of capital and their impacts on our world.